You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again, live for a little bit of the old Education Wednesday goodness. Yes, it is time once again for Options Bootcamp, the premier options educational program. I can say that. I see the numbers. Options Bootcamp. You folks love it. You folks just eat it up all the time. Of course, if you want to eat more, you want to devour more, we won't hold it against you. You know where to go. Check out our full network. I know a lot of you come in, you just discover boot camp for it, and you love boot camp. Hey, we don't mind. You love boot camp. That's cool. But we do have a whole bunch of other shows we do here on the network as well. So make sure if you're not listening to those, you haven't upgraded yourself to our full network feed wherever you're getting this show, then you're doing yourself a disservice. Quite a few, nearly a dozen programs coming at you. And then on top of that, if you want more goodness, you want to get bumped to the top of the list for all of our questions, you want to listen live to this and every other show we do here on the network, you want to get exclusive content like our pro Q&A's, got the once and future and now present Dr. Vic's coming up this week, as well as, of course, Options Oddities. Had a great trifecta episode last Friday. You know where to go to get access to all that fun stuff, theoptionsinsider.com/pro. It also gives you access. We're going to give it away tomorrow. Access to the giveaway for the July Pro Trade and Crate. Man, we got crates flying fast and furious out of the studio. And, I still haven't made a dent in the mountain of cool stuff we have for you folks over there. So theoptionsinsider.com/pro. Get entered so I can give you cool stuff. I mean, what more can I say out there? But you know what? There's one person I will not give cool stuff to, and he knows why. He is the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, who apparently the Skype gods and us. There he is. All right, Mr. Black-Hatted One. How you doing out there today, sir?
I'm doing wonderful. How are you, my friend?
I am doing just peachy. Peachy keen. Is that what the kids say these days? I'm peachy keen. Top of the morning, Governor. Is that what the kids are all up to now?
I think you're thinking of 1959.
Oh, I was just 50 years off in my nomenclature. I apologize, listeners, for offending all you kids. I know boot camp in particular tends to skew a little bit younger, so I probably offended some folks out there, Mr. P. We might offend some folks with our episode title today as well, but don't blame me and blame Dan because we got some good fun stuff in store for you. A little bit of the old options drills.
Holy mooch! Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills, a portion of the show where we break down a concept, maybe we've touched on it before to some degree, and explore perhaps a new facet of it or explain how you can implement it in an interesting way in your portfolio. Chat's nervous. Nichols saying, is Dan going to go blue again? No. Well, I don't think so. I guess we'll find out. But he did inspire our topic for today, which which we are colloquially referring to in the family-friendly version of how not to F up your credit spreads. Mr. Dan, we can always count on you for a colorful segment title, if nothing else, sir. Well done.
Well, I think it's an important lesson because I've seen some of those get effed up pretty good, and so let's make sure that doesn't happen to you.
We like our listeners here. Don't go around effing up your credit spreads. All right. I see the numbers. I know there's a lot of new people pouring in all the time. Biggest month in the history of the network last month. So a lot of you are probably new to this concept. So, hey, first off, I said it before. If you haven't done so, go back to the beginning, episode 1. A lot of you are doing it. I see the numbers for that too. But if you do that, you'll see a lot of episodes about credit spreads. Still, at these terms we're going to throw around here, all this terminology is a little bit confusing to you. We'll do a little bit basic definition right at the top here. So credit versus debit spread, just like it sounds. If you're going to your accountant, you're doing basic debits and credits, right? The debit is an outlay. You're paying for something. A credit is something you're collecting. So it's basic debit spread, everybody's favorite, XYZ, right? You walk into XYZ, you say, I like XYZ. I'm kind of bullish on it. I'm going to buy, let's say, a 1 month at the money call. Let's say in our scenario, that cost $1. And now I'm going to turn around because I want to do a spread. I listened to this show, so I've learned about spreads. I say I'm going to sell, let's say, a 10% out of the money call against it. In this case, that gets us 25 cents. So our net debit, the net cost, the net outlay for this trade, 75 cents. Of course, if you flip this around, that's what we're talking about today. Credit spreads. What if I sell this spread? So I sell this at the money call now for $1. I think XYZ is going to hang out here, maybe a little bit below over this 1 month period. But just in case I'm wrong, I've listened to this show. I've learned about spreads. I learned about mitigating my risk. I decided to buy a 10% out of the money call for a quarter this time. So this time I collect a net credit of 75 cents. And that's where we're going to dive into today. But by the way, before we even get into all that fun stuff as well, there's a popular misconception out there that debit equals buying and credit equals selling. And for the most part, that is true. But there are scenarios where you could end up collecting a credit when you buy something and paying a debit when you sell something. For example, ratio spreads. It's a very common offender in this. It's easy to quote unquote buy a 1x2, buy one, sell two, and have it be a net credit. In fact, listen to some of our shows are by the Rock Lobster. He only will do those if we can get credits and things. So it is easy to do that, and vice versa. Of course, it is easy to sell a ratio spread and have to pay a debit for the privilege. So not all debits are buys and not all credits are sales, even though most of them fall into that category. All right, Dan, we've set the table for the legion of newbies that have joined us here in the last few months. But this was your baby. You want to dive into the non-family friendly version of the content. So what are your thoughts, sir? How should I not F up my credit spreads?
Oh, man. So there are a lot of ways in which to do so. Let's start talking about some of them. So let's go through a couple of misconceptions and then mistakes and then best practices. So one misconception is that because theta is on your side, there's an inherent advantage to the trade. I would say that is a silly way to think about it. What is the trade-off for theta? Like theta exists. People buy options. Are they just foolish for buying options? No, they're buying something that has a value. And what is the value? The value is, in a word, volatility. That statement's going to need a little justification and clarification. But you can kind of do one of two things with options, right? You can use them to hedge and protect against volatility, right? If you own stock and you think the stock's probably going to go up, but you're afraid it might go down, you're afraid there's going to be higher volatility, you wouldn't sell your stock if you still think that it has a chance of going up. You'd buy a put, right? If you want to speculate, but you want to do it risking less, or you want to speculate on a non-directional thing, buy like a straddle, you buy options, right? And so, there literally is a value of paying premium over parity for options. if all options were free, I mean, the entire world would buy them. Like that value is derived from a couple things: the possibility of volatility and time. And so as time passes, there's less chance of something to happen. And so that's where we get time decay from. It is just a change in the value because there's a change in the amount of time that something can happen. So what's the option? Like, so what is it you're buying? You're buying this volatility, this, potential movement in the underlying. Okay. And as far as Greeks go, we call that gamma. So there's always this inherent trade-off. If we're going to be the quote unquote smart money, right, where we're getting theta every day, we're not just losing that asset that is movement, that is gamma, we're turning that into a detriment. And with credit spreads, you have a smaller maximum profit than relative to your maximum loss. Another way of saying that is your risk reward is sort of disparate. You stand to make much less than you stand to lose. And hey, that's okay too, because it's a high probability trade. So there's kind of a lot going on there. So misconception number one is just simply that, just because you have theta on your side, it's an advantage. You're accepting the disadvantage that if it moves against you, you can lose much more than you can make. So that becomes a fair trade-off. That's what the options pricing model guarantees, is that it is a fair trade-off. Okay, so is there the chance of having an advantage? Yes, there is. But we'll get to that in a second. Let's see, what other misconceptions are there? I just did a presentation with our Trade Smart workshop, which is our Thursday class, and I did a presentation on exactly this. Another misconception is that, hey, I'm getting the credit now, and so that's somehow better. Okay, if interest rates were like 40% a day, then that would be great to get the credit now, but it just doesn't matter. And on top of that, you have to tie up margin money. So even if you're technically getting money in your account, you're still tying up your money. You're effectively paying for it anyway. So some mistakes come into play where because, oh wait, one more misconception. Sorry about that. Is that because it's a high probability position, and if you set up your credit spreads right, because it's a high probability position, it's somehow better. And that's a silly misconception. Like, I do this exercise in our classes when we're talking about things of this nature. I do the coin flip game, right? And anybody who's had a statistics class knows the coin flip game. If I flip a coin, heads comes up, you get $1. If I flip a coin and tails comes up, you get nothing. First, do you want to play this game? Yes. If you don't want to play this game, stop listening to this podcast. Trading's not for you. Like, you want to play that game because you can't lose anything. All right. So now let's make it more realistic. You have to pay for each coin flip. How much would you be willing to pay for each coin flip? Long story short, we're not going to play the guessing game. Anywhere less than 50 cents, because the expected value of a coin flip is, well, one permutation, I get $1. The second permutation, I get $0. There's only two permutations. So 1 plus 0 equals 1 divided by 2 is 50 cents. That's the value of a coin flip. You would be willing to pay, to bet on any one of these flips, anything less than 50 cents. Okay, so now how does this leave us with credit spreads? It's a different game. It's not a 50-50 chance. That would be more like if 1, 2, 3, 4, 5 comes up, you get $1. If 6 comes up, you get nothing. Who wants to play that game? Everybody wants to play that game. Okay, you have to pay for it. How much would you be willing to pay for it? Math's a little harder. You have to think about it a little bit, but you win 5 out of 6 times. You lose 1 out of 6 times. 1 divided by 6, well, actually, 5 divided by 6 is 83 cents, 83 and a third cents. And so you would literally be willing to pay up to 83 and a third cents. So every time you win, you're basically making 16 cents. Every time you lose, you're losing 83 cents. So this is the nature of credit spreads. If you paid 83 and a third cents for each coin flip, just because it's a high probability scenario game, it's not a good game. If you paid 90 cents per coin flip and you did it 1,000 times, you would lose money, even though the odds of winning are 5 to 1. So this is the nature of credit spreads. And so I guess the biggest mistakes are believing in these misconceptions that theta is just an inherent advantage. That probability of success means that it's an inherent advantage. It's not. And the last thing I want you to think is that I'm poo-pooing credit spreads, because credit spreads are probably one of the most common trades I make. Credit spreads are great because when you understand that the baloney you hear in 3-minute YouTube videos by somebody who's got animated dollar bills falling in the background behind them talks about, oh, we have theta on our side. It's high probability. It's great. That's just the game. Now you got to figure out how to win the game. And so the best practices are this. The best practices are get edge. If you're playing that dice game, try and pay 75 cents, right? So that you're playing a game that has a positive expected return. You have value. Now, how do we do that? Well, we need to put some things literally on our side, not just superficially pretend they're on our side. We need to put some things that are literally on our side. We need to get edge, which is what every good trade has to have. So the first thing we do is we use something that is not related to the option pricing model. Because anything in the option pricing model, including derivatives of it, like delta, gamma, theta, vega, are all designed to create fair value situations and find a theoretical value. So we need to use something that's not factored in there that might have some influence over the value of your trade. And one of those things is technical analysis. And the simplest one of those, and arguably the best one of those, is support and resistance. Very exciting. Oh, yes. You should see when I trade all the fancy lines on my screen. Not. You guys who listen to this podcast and have for a while, or even if you just started, you know that my method is to keep things as simple as possible and clear and not try and be fancy. Fancy doesn't help anybody. So when we have support for put credit spreads or resistance for call credit spreads, if we set our short strike on the other side of those, we end up with an inherent advantage because support and resistance tend to hold more often than not. Now, even if that statement is true 52% of the time, that it holds 52% of the time and breaks 48% of the time, it's still an edge. So you're putting on a statistically advantageous trade. And then we look at volatility to sell only overpriced volatility, which we've talked about in some other shows. I don't want to belabor that point here and go down a rabbit hole on that because it's a long conversation. But if you're only selling overpriced volatility, that means that the theta you're getting is actually overpriced. You're getting paid too much. It's like, you own an apartment building on a row of buildings that all look the same, and everybody else on the block is getting $500 a month rent, but you're getting $600 a month rent. That's the situation that you want to find, is these little nuances, these little unique opportunities. Trading's an opportunity business, and being able to get edge on credit spreads is super, super powerful. All right, I believe that I just hogged a whole bunch of the conversation with my soliloquy. Mark, you can turn off the spotlight that was on me.
No, I love it. That was great. That was one of your longest unbroken soliloquies on this show, which was great. Our listeners appreciate it. My voice thanks you. So I think everyone is happy with that. There is this weird misperception out there, Dan, that, credit equals good and debit equals bad, right? How many new listeners for us, new customers and clients for you have come over there to MTM, and they've had that perception, right? Like, oh, why do I pay for something? I could get a credit, right? And it's much better, infinitely better. I'm collecting, therefore I win. And, hopefully, if we've done nothing else, listeners, we have disabused you of that notion, not just on today's episode, but through the entirety of this program here. I mean, at the end of the day, sometimes things are worth paying for. Don't tell my buddy, Mr. Schlesinger, who says options are to be sold or not sold. Sometimes it is worth paying for things out there, as we have broken down many times in the past. Speaking of breaking things down, let's get to some of your queries now. It is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, we got some questions of the week I want to pay off here. But first, let's go out to our live listeners. Our live chat always bumped to the top of the list. We love all you folks. Let's just go in order here. Let's start with Nichols, because he's talking about what we were just talking about. Nichols says, what are Dan's thoughts on trading 1x2 spreads? Does he like them? Does he view them as a credit spread, even though you're technically buying the spread? Yeah, Nichols, this is kind of what I was just referring to at the top of the last segment. There are many ways where that whole debit credit viewpoint gets a little bit blurry, and that ratio spreads are a prime prime example of that. You could easily buy a 1x2, quote unquote, buy it because you're buying the meatier, closer to at the money usually option in that case, and then selling two usually farther out of the money options against it. But because you're selling 2 versus 1, you could easily collect a credit to do that, and then it does become technically a credit spread, even though the mechanics are a lot different. Dan, we talked about ratio spreads in the past. We didn't really get to them in the last segment here. So what are your thoughts for Mr. Nichols about 1x2s? Do you like them? And do you view them as a credit spread, even though you're technically buying it?
Yeah. So all strategies have their place. They're like my children. I don't have a favorite. But that said, they do all have their place in the ecosystem that is option trading. And so, yeah, I like them for what they're designed to do. I like them for the right purpose. I haven't been trading a lot of them over the past few years, but I don't know, they just sort of became something that I just didn't show up on my radar. And it's kind of making me think that maybe it's not the worst thing to maybe make one of my choices again. Those of you, especially those of you who are current students, I always like to say, hey, whenever you identify a trading opportunity, you should always look for 3 different ways to trade it and then pick the best one. And so I think it's not a bad idea to weigh ratio spreads as one of those choices. Now, the question, do I look at it as a credit spread or a debit spread or what? I guess the reason why I respect them and want to look at them, but maybe haven't given them all the attention that some people do, is because I tend to look at it as a debit spread with a naked option, which it is, but it's also something different when combined. The selling a naked, selling more options than you're buying leaves you with a potentially big risk when something crazy happens, which is called a red swan, which seldom happens. But when it does, it can be a little dicey. We've talked about this a million times on the show that I'm definitely a fan of selling cash secured puts as a way to acquire the stock, basically hoping I get a sign, not trying to skate. Whereas when you're doing one of these credit spreads where you sell two or more options and buy one option, a ratio spread, you're generally not hoping to get a sign. You're generally hoping to skate on that extra one, and if it starts going against you, against that extra naked one, the theory is that you'll make enough on the debit spread portion of that to offset what you're losing on the quote unquote naked portion of that. So maybe you can, if it's going against you, maybe you can even get out for a profit. It's just the fast, violent move that's the only tricky thing and scary thing. But, there's definitely been some times when I felt that having a naked component to a spread or just a plain old naked option is the smartest, most edge-worthy way to trade it. So, I like it, and I might even model them out a little bit more going forward.
Yeah, we just talked on the show recently about stock repair trades, and those are effectively, call ratio spreads. That's one of the more typical use cases on the call side for these types of ratios, because obviously if you're just doing them 1x2 without the stock leg, that's a lot of upside risk there. So we tend to usually counsel maybe turn it into a butterfly or something else, because as we saw last year, there's upside risk too, not just downside. I've actually been playing around with some ratio put spreads on the downside lately, which is obviously kind of an interesting way to capture some momentum to the downside, maybe also on the put side really, and also maybe pick up some stock at levels that maybe could be attractive, especially if you can get that spread off for an attractive level there. So there's some interesting use cases for them. Maybe we'll go back. I know we have touched on ratio put spreads in the past, but maybe it's time to refresh and revisit those in light of what we've been seeing out there in the market of late. Let's go back out to the live again. Let's go to Age of Delaquarius. He says, since Robinhood laid off 25% of their staff, maybe some comments about the current retail space. With Schwab and TD merging, it seems like it is getting more limited and not necessarily good for traders. Yeah, that trend has been moving in that direction for some time, Age. I kind of refer to them as the Leviathans. The Leviathans have only gotten bigger. In the past, there were a lot of small fish, a lot of minnows floating around that the big Leviathans would eventually gobble up and get bigger. They have gobbled up most of those smaller fish now. And as a result, there are fewer small little minnows floating around that you guys can really play around with and kick the tires on the options front. Now, back in the day, there was Options Express and Thinkorswim. There was Trade King. There was, IB. There was a bunch of them. E-Trade was playing with it, but not doing much. They were starting to dip their toes in it. Then other big banks started getting involved. And, one by one, they all started gobbling each other up. Trade King is now Ally Invest. They got gobbled up by Ally. We have, of course, the big one, which is Schwab acquiring TD, which to this day is still one of the more impressively Machiavellian things I've seen go on in the space. Schwab makes a lot of its money not off transaction. They have other things. They have asset management, RIAs, and a lot of other areas of their business that do well regardless of commission costs. But they knew TD was very heavily based around transactional revenue. And so they just cut their legs out from them when they followed the Robinhood model and said, hey, we're going to go commission free as well. Then everyone else had to do it, including TD. And then, of course, they were able to scoop up TD for pennies on the dollar. It was impressively Machiavellian. I tip my cap to them out there. But you're right, there aren't a lot of new players. I mean, we have Gatsby. We have the Weebles out there. You had Tasty. They're now part of a big conglomerate as well. They got gobbled up. They're now part of the same group that owns Nadex and everything else. So the smaller players are few and far between. You have the Weebles, Robinhood. I don't know, they're a small player anymore. They're a newer entrant, but they're pretty big. So for new players, you're right. It is kind of slim pickings out there. The default answer for a lot of people is still the monstrosity that is Schwab, because they have so many options platforms. They have OX there. They have TOS. They have kind of merged some of that together. There's the legacy Schwab, which nobody wants to use, and the legacy TD. Nobody wants to use that either. But the TOS stuff and the OX stuff are all pretty good. So you can kind of pick your poison amongst those at what you prefer. And then, of course, for the more experienced and savvy out there, IB is a pretty good choice as well. But don't go there if you're a listener of this show and you're new to options. IB, they don't want your business. They don't want a newcomer. They want the more hardcore, the more experienced, more seasoned people out there. Yeah, and you're right. Then others, we haven't really seen much from Gatsby yet, and kind of Weeble kind of playing in that same Robin Hood space. So we don't know what's going to happen to either of these big players now that PFOF is kind of on the chopping block, or at least on the changing block. So there are a lot of questions out there right now. You're right. It is not the best time. I mean, obviously, cost-wise and everything else, it's a good time for retail. But from a plethora of options, pun intended, perspective, you're right. It isn't the best time. You kind of have TD or Schwab, and that's kind of the big dog. And everything else is kind of floating around them. Obviously, what Brian and the folks over there at Ally have been doing for a while. They were very early, even when they were Trade King, on the community front. So they've always kind of fostered community, even before social media was big and everything else like that. So I've always liked that approach. And obviously they're very education focused because of look what they do with Brian and the OPR and everything else out there. So I like that focus. And so I'd be remiss if I didn't mention them. Now they are a sponsor of the network. So read into that what you will, but they're a sponsor for a reason. I like what they do. And they're good for smaller account sizes too. That's kind of their niche, their bread and butter. So yeah, your choices, unfortunately, are few and farther between. Usually this is the point where we would see some new startups get fired up and start trying to come into the space to disrupt and eventually get acquired. The Gatsby folks have told me on no uncertain terms that is their goal. They want to get acquired. So interesting stuff out here. I don't know, Dan, what are your thoughts as Age put it on kind of the state of the current retail landscape right now, sir?
Well, I mean, it's the best time in the world ever to be a retail trader, and I hope that continues. But it's getting increasingly more difficult to be a retail broker. And this started. It's been a long saga. It started in like 2000 or so when they started accepting payment for order flow. And I remember standing in the pit on the trading floor being like, wait a minute, what now? Like the person, like somebody can just pay a broker to be able to not let anybody else see it, not let there be any more, not let there be competition. Like, how is that even remotely legal? And, people are just like, oh, I don't know, man, but they've been doing this in the stock market for years. Now they're doing the options market, and it's going to happen, and you can't fight it. And so then everybody just kind of fell on their swords and said, yeah, well, we're not going to fight it. The exchanges didn't fight it. Nobody fought it. And now we live in that world, and they're talking about reversing that. Gensler's talking about reversing that. And if he does, it's going to be a little bit of a nuclear bomb for revenues for the retail brokers. And, they're going to have to raise their prices some, and they're going to have to think of a new model, and they're going to have to offer new services. They're going to have to think through a new way to make money. I know anecdotally, I just heard through the grapevine like a year or so ago that the plan would be to get more into crypto, but now that's not a really viable plan. So it's tough out there. It's tough out there for the brokers. Economies of scale always helps any business, at least if they do it right. So I think that's why we're seeing a lot of these things happen. And I think we're going to keep seeing those. I think because things are electronic, brokerage firms are going to have to do one thing or the other, or both, lay off more people or have ancillary businesses that complement the brokerage business and make money. And, I think we might have done a whole show dedicated to this a couple of months ago, and just saying how will that affect the retail trader, all this stuff that is not necessarily inevitable, but definitely possible. And I do have hope that it won't affect it very negatively, but we'll see how it plays out. It's a bit of a quandary.
Yeah. I never forget the first day I encountered PFOF on the floor of the sea. But I was kind of like you. I was like, how is this legal? This makes no sense. And, I hung around for a bit longer, expecting the exchange to the exchange to step up and maybe protest it. They did not. At that point, they were all becoming for-profit public entities, so they needed the revenue. They didn't really care where it came from. And then, of course, when they started allowing brokers to cross things on my bid and offer, Dan, that's when I said, you know what? This is for the birds. I'm out of here. That's when I saw that. I knew the writing was already trending that way, but the writing was clearly on the wall, and they allowed them to just cross stuff without even improving markets. There are no protections left. This is going the way of the dodo. Time to move on. So intriguing stuff. Yeah, I think this is kind of very much a wait-and-see time here, Age. We don't know what the future of PFOF is going to be. A lot of the brokers have leaned on it very heavily in recent years as margin has gone away, and now we've seen commissions go away. PFOF is kind of the last leg of that stool right now. If that leg comes undone, what's left? I certainly would not want to be in the brokerage business right now. It's a very challenging space. Rates are at least coming back, so you can make a little money on margin these days, so maybe that'll ease their pain somewhat. But yeah, these are difficult times for brokers. That's why at least a big one like Schwab, where they have other buckets, other businesses that aren't as transactionally based, that at least could be a little bit of a solace. They're going to be around for a bit, whereas it might be more of a question mark with a Webull or Robinhood or some of these newer participants out there. I forgot to mention, blanking on their names now as well. They do all you can eat options trading. I should have mentioned them as well. And I'm neglecting to remember what their name is right now, which is not good. But a Tradier. There we go. The Tradier folks, they have kind of their all you can eat, which was a cooler deal when things were a little bit more expensive, but still intriguing stuff nonetheless out there. So there are some players you can still keep an eye on here. Speaking of keep an eye on things, let's keep an eye on our questions of the week and how you folks are trending. Let's take the pulse of you folks, the audience. Let's go last week first. You guys kind of got this one wrong. I don't blame you. I was kind of in the same camp. We asked you last week, the Fed is back, sending traders into a tizzy about rates. But if you had to buy a SPY at the money call, at the time, SPY was below 4,000, about 39.70. Expiring at the end of the week, which way would you go? And 57% of you chose to buy a SPY at the money put. You were fading that rally. We all know how it worked out. SPY closed over 4,000. So alas, that was not the right pick. 36% of you said you wanted to buy the call, and about 7% of you said you were buying the straddle because you were greedy. So you folks may have worked out, depending on how much you pay for that straddle, but we didn't get into that. This week, we have a more specific question. We said the artist formerly known as Facebook, aka Meta, is struggling right now. The stock is down over 50% on the year, currently trading at 163 when we posted this poll. Let's see where our friend Meta is hanging out right now. Meta, 168. Nice pop, 8 points or 5% today. So they have moved a little bit. They're going to start selling some bonds. People are liking that. The first ever corporate bond sale. Maybe a sign of the times for Facebook. Anyway, the stock is down 50% on the year, currently trading 163. If you had to purchase an at-the-money call or put expiring at the end of the year, December 31st, which way would you go? You buy the put, you're thinking there's more downside. The call, you think we got more upside to come, or you're just done with Facebook/Meta. You're washing your hands of it entirely. Mr. Dan, what is your vote if you have one, sir? And more importantly, what do you think our audience is voting for?
Oh man, I was just asking myself the same question earlier, and the answer I want to give, but I can't, is straddle. I'm greedy. Because straddles are just so gosh darn tough. Not to mention I'm going to be heading out of town for about 10 days, and I don't like to have trades that need to be monitored heavily. I'll put on some covered calls, but nothing like a straddle. And I'm just looking at it, and I'm like, ooh, I don't know. I think the straddles are just a little I think they're going to be too hard to trade. I'd say more often than not, when you buy a straddle, you lose money, which is okay if you manage it properly, because your winners will be much bigger than your losers. And I don't think we're there yet. So I guess what I was looking at doing is waiting to see how it plays out. And if we get into like some more overbought territory, like RSI overbought, and maybe some other indicators, and especially as we get closer to that 200-day moving average, I would definitely start looking towards fading the rally for sure. And I might end up waiting too long and seeing a pullback before any of that happens. But that's been my plan for the broad market. Let's wait and see. If we get some further overextension, then it's fade time.
Now let's see what our audience is up to, Mr. Dan. And let's see, right now, 51.3% saying, look out below, you're buying that put on Meta. 25.6% saying, you're buying that call, rally ho time, worked out today, maybe get the heck out of Dodge. And 23.1% of you saying, you're done with Meta/Facebook entirely. You have no interest. I was looking here, Dan, while you were talking. This is an interesting factoid because everyone's all hyped about Facebook selling bonds for the first time ever. Maybe a bit of I might view that as more of a bearish sign. They have to start borrowing money. They never needed to before. Now, all of a sudden, they do. But interestingly enough, they are one of just 18 companies in the S&P 500 without any outstanding short or long-term debt, Dan. So, intriguing thing. I would kind of almost view that as bearish. Now they have to start borrowing to feed the beast, Dan. Does that make you excited? Make you want to pop the stock by 8% or whatever it's rallying today here?
It's interesting is what it is. For them to be able to just not have any debt is amazingly impressive. The one thing that I know, and when I say no, I mean have some superficial research that I've done. I haven't done a super deep dive into it. Is that Meta per the conference call following their earnings before this last earnings, 2 earnings ago, they're changing their business model quite a bit. They're getting a little bit more away from the controversial data mining ads that have been their bread and butter, that made them so much money that they practically invented in a brilliant sort of way, more towards the metaverse. And there was talk about them launching their own crypto that could be part of their own metaverse platform, along with their, the headsets that are also part of the metaverse platform, like really changing into something. And I think that a company that has had the vision that they had, and, there's respect there, not necessarily that I'm a fan of what has gone on there and still goes on there, or some of the leadership. But you got to respect the brilliance of what they created, even if it's a 3-headed monster. You got to respect what they've done. They're smart people. And so I just imagine that in order to reinvent the company, or at least create this whole new branch, going out and borrowing a bunch of money is how most businesses start. I mean, it's almost like a startup within the company, right? To completely change a large portion of their business. So I don't know. I mean, a bunch of really, really smart people borrowing money to launch a business that they probably know more than anybody in the world about. I don't know. I mean, it could be good. It could be good. And don't get me wrong, I'm not trying to give them too much credit. Again, not necessarily a fan, but I wouldn't be surprised if they pull it off.
You heard it here, listeners. Dan Passarelli, the #1 fan of Mark Zuckerberg and Facebook. He has that. Don't you have that tattoo on your left butt cheek, sir? The Zuckerberg face. You wake up every morning, see a little Zuck there for you. A little bit too much of a glimpse into the life of Mr. Passarelli. By the way, Unlimited in our chat saying Meta has raised their price on their VR headset. It's not a new model. It doesn't come with anything new. They just raised the price $100 on it. Well, we are in those inflationary times there, Unlimited, but I don't know if that's to account for. I think it's more the bond sale. But yes, those are the times we live in. Massive inflation across the board. Nothing new, but you're paying more for it. Good times for all of us. What are your thoughts on all this stuff, listeners, on Facebook/Meta, You could vote in our poll right now. At Options is the place to go to learn more. Of course, if you have questions you want us to discuss here on the show, theoptionsinsider.com is the place to go. Questions at theoptionsinsider.com works, of course, for our live listeners, our pro members. You guys get bumped to the top of the list. We love all you folks out there who take the time to listen. Of course, if you're one of our many on-demand listeners, we ask that you keep rating and reviewing. Obviously, it is helping a lot of new folks discover the show week after week, month after month. We do appreciate it. So if you like what you hear, keep rating and reviewing. And Mr. P, if folks want to check out what you got cooking, maybe they have questions about this whole credit spread, debit spread thing, sir. Where should they go? What should they do?
Well, you're actually you got some pretty good timing if you're listening live or listening pretty shortly after live. Go to markettaker.com and here's what you should do. If you're really into credit spreads, go to markettaker.com, click join free, and that'll give you access to some of our content for right now, free access to our community chat room. And it also put you on our email list, which is important because not only do we send out a daily video on my market thoughts and a weekly newsletter that has a lot of great information on it. In about 3 weeks, we're going to send you an invitation to a webinar that talks about a brand new credit spread finding service that you are going to love. There's literally nothing else out there like it, and it's literally the best way to easily, quickly identify not just high probability spreads, not just positive theta spreads, but spreads that legit have edge that professional traders are actually trading too. So go to markettaker.com, join the email list, enjoy the content in the meantime, but in about 3 weeks, attend that webinar. You're gonna like what we're building here for you.
There you go, markettaker.com. Don't forget the second T for Theta, because why not? Over there, markettaker.com is the place to go. We got to get on out of here. Brian will be coming at you later on demand, listeners. So all of you who want more education in your life, stay tuned for OPR. Of course, we'll be back again live tomorrow with Dan the Man Gramza, the other Dan, popping in on the program here for TWIFO tomorrow, as well as episode Due for the option block. Everyone's moving hither and yon. No idea who's going to join me on the option block tomorrow, so it should be a fun time. It'll be a spin the wheel of guest co-host. Then, of course, back again Friday for yet another amazing content trifecta for all you pro folks. First off, vol views for everybody, even the on-demand folks, starting at noon. Then after that, the double dose of options oddities, as well as your pro Q&A with the once, future, and present Dr. Vic. So some of you are already started sending in your questions. Get those questions in now, folks. Those usually get pretty popular there. Then we're back again next week, all the way through to another Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.